While North Korea decided to join the 4th of July celebrations with a few of its own rockets, the jobs report sputtered out for the third consecutive month. And despite weak jobs, strong hourly earnings will certainly worry the Fed. I'm Beth Ambovino, the senior economist at Standard & Poor's. The 121,000 gains in payrolls was much weaker than the market had expected, in contrast to upbeat initial claims data and the strong report from the ADP. Retail continued to lose jobs, and even construction was weak. Healthcare was a bright spot, and manufacturing improved. On the bright side as well, unemployment rate held at 4.6%, and the household measure of employment was up strongly again, continuing the discrepancy with the payroll data and likely indicating jobs increased at small firms and contract employment. Despite the weak job growth, the Fed will be worried about the 0.5% rise in average hourly earnings. The data showed continued acceleration in earnings, and the year-over-year 3.9% increase is the largest in 5 years. Weekly hours were up 0.1 to 33.9, recovering from their May drop, which will help spending power for the consumers, with average weekly earnings now up 4.6% from a year earlier. Still, chain store sales grew just 2.6% in June, almost half the May level, and was mixed across retailers. While weather was a factor, apparently consumers are finally squeezed by high oil prices and rising interest rates. The U.S. trade deficit widened to $63.8 billion in May from $63.3 billion in April. This narrowing suggests a strong second quarter growth, stronger than the 2.9% we currently project. Exports increased 2.4% to $118.7 billion. This is the biggest percentage change since December 2004. Imports rose in energy-related 1.8% to $182.5 billion. But excluding energy, the trade deficit is narrowing.